Hello and happy new year, everybody. It's Justin Nielsen here, and welcome to the SwingTrader status update. This is our weekly show that we do on Tuesdays at roughly a little bit after 2 p.m. Pacific time. We just kind of talk a little bit about what we're doing on our SwingTrader product. It's open for everyone, but we also kind of refer to some of the things that we're doing, and also kind of help give guidance in terms of some swing trading strategies and market stuff that we're using, and of course to help walk us all through this, as he does every week, it's Mike Webster joining me. He is, of course, our director of market strategy or
I think
something,
it's technically random dude who shows up
something like
online
that.
sometimes. Yeah.
Yeah, and for those that like maybe don't recognize exactly, like, oh gosh, these guys, were they always this old? I wanted to share a few pictures. Here is Mike and I back when we met. This was back in 1998, February of 1998, so nearly 27 years ago, where we first met, working a satellite seminar with Bill O'Neill, as the host in Los Angeles, and we were in Philadelphia. He did a satellite seminar across 20 different cities, and some of these cities were just filled with like 1,000 people or so. But yeah, Mike and I, we go way back. So here we are
That was such
touring.
a fun trip. I'm so happy you found those pictures. It was God, that was such a good time, and I still remember like the company was so cheap that they had to share a room.
Yeah, so it was
Um,
basically, hi, Mike Webster, nice to meet you. I guess I'll be your roommate for a few days.
and I remember I had just gotten my favorite book ever, How to Trade in Stocks by Jesse Livermore. I brought that along, but didn't get a chance to read it because we were hanging out and we went up to. Didn't we go to the Taj Mahal in
We went to the
Atlantic
Taj
City?
Mahal, Atlantic City. We went to Independence Hall, Liberty Bell. Yeah, we did it up. So
And I was so nervous
anyway,
talking to folks there. Oh my God, I was. You weren't at all. I was so nervous.
and look at you now, just talking every week. Well, multiple times a week. So for those that don't know, Mike Webster is also on the Stock Market Today video on Fridays, and also on IBD Live. But let's talk a little bit about this market, because man, it has been kind of a time here. Here's the NASDAQ composite that I'm showing right now. And of course, one of the things that kind of stuck out about the last month here is we were in this nice solid uptrend, and everything was looking good. We were getting above 20,000. The birds were singing, the sun was shining, and then the Fed reaction, and really, really ugly action here on the 18th of December. And we talked about this last time about, okay, what typically happens when you get a break like that, but you're still in a power trend? What typically happens? And we went through a number of examples of, look, sometimes you recover pretty quickly. Sometimes you take a lot of time, like a couple months or more, in order to kind of work your way through it. That's actually what happens in the majority of the case. And then sometimes it takes you a lot longer and that was the minority of the cases.
Do you want to share that the ATR break?
I can. You know what? I'll do
Yeah.
that real quick. So yeah, I'm going to go back to our. Let's see. I will share that right now. So here was some of the precedents that we kind of drew up. We went through, and basically I went through my spreadsheet on the NASDAQ composite going back all the way to 1973. And we did an adjustment for the ATR drop. So that particular day, we were looking for, okay, what did we decide that day was? It was
Either a or the 2 ATR using the 21-day ATR going into that.
Yeah.
Or a 3 ATR, which is the ones with the darker green over on the right. And I believe we had going into the day that the power trend was on, and that our high was above the 21-day coming into it. And I think that's the only restrictions that we put on there, right?
Yeah. It was very basic, but a lot of examples. And again, the idea behind precedents is to just kind of let you know what could happen, what typically happens. You can't ever hang your hat and say this is what's going to happen, because as we've learned, a lot of times the market will do what the market's going to do. So you've just got to be aware of that, and know when to say, okay, yeah, this is kind of following the norm, and to know when it's no longer doing the norm and it's doing one of those outlier cases, or what have you. So
That's the
don't hang
most
your hat on
important part.
precedents.
That's the most important part of a precedent. The precedents are so powerful. Some people don't use them. Bill O'Neill, founder of IBD, was, the one that we both learned, to use precedents from, and then we kind of took it in different ways because he would tend to do it based on individual stocks, like, oh, this stock reminds me of, Bethlehem Steel in this year or what have
Mm-hmm.
you. But when you and I have been doing this together for a few decades, we're looking at a market action primarily. Like, okay, the Nasdaq did this on this day. Let's go back and look at other times when the Nasdaq did that, and it's very helpful. And it's tricky. There's that balance between, if you put the restrictions in there that are too tight,
Yeah.
you'll miss stuff, and if you put it in too big, and you get the phone book essentially, it's not really helpful. So that's why we did this in two versions. The ATR is more of the phone book type, and then the three ATRs, because it was a three ATR break on, I think it was December 18th on the Fed day.
Mm-hmm.
So those are, if you don't have a lot of time, just focus on the ones on the right and go into Market Surge or whatever product you use and do a change date, go back to that actual date in question, and then go out a month or two and then see what ended up happening. And I put this out on my Twitter handle, back after that happened. It is very helpful to go through, and you and I went through for quite a while and went over all of these together. Let's go back to the Nasdaq, so people kind of see what we're talking about. That bad, nasty break on the Fed day. That's what those examples were of.
Yeah.
And
So there was a question on YouTube I'm seeing in the comments. Someone was asking, is that a 2 to 3 ATR drop from the 21 day? That was a 2 to 3 ATR drop on that day.
yeah,
So not necessarily from the 21 day, just that day, just to kind of show you how bad it was relative to recent action.
yeah, exactly. And so when you have that unusual break in that position, we just wanted to see what was normal afterwards. And frankly, this is normal. This is actually on the
Yeah,
good side.
this is the norm.
Yeah, this is, and on the good side of norm, because when we were looking at those examples, a lot of them went a lot lower. Like, there was a real strong possibility after that break that we came down and tested the 200 day.
Mhm.
But what we have here now is kind of relatively normal and constructive. I know today was painful. It was painful for me. It was painful for anyone in the market, or most people, unless you happen to have, an outlier that just really made up for what, most stocks got hit really hard. Like, let's pull up Nvidia, because that's what everyone is probably, been trading. We're trading it. That's a substantial, when, a big stock like that is down 6% on the day, after what was, appeared to be good news yesterday. It's kind of, is it, buy the rumor, sell the news type of event at this point. That's what it looks like. But it did hold at the 50-day, but it certainly damaged. That's not what you want to see. But let's go back to the Nasdaq for a second. And so there was a lot of damage there, but this is kind of normal, because we've got a few things going on. One, we've got that bad break that happened after the Fed, and this digestion time frame. Because what happened is, you're trending nicely, kind of relatively tight days, and then you get this bad break, and the market needs to adjust for that. And unfortunately, this happened at a time where it's already adjusting to the cross currents of the political thing changing, with a new president coming in soon. So you've got all those changes that are happening on a more on a sector basis, as people think certain groups are going to be helped by the administration, other ones going to be hurt. So you have everyone figuring that out. Then you have the Fed basically changing their stance. They're saying, like, Powell's like, hey, we're going to slow down now and wait for the data, because we don't know how the new administration is going to impact the economy. Well, it was very different than his tone that he had before. Was politics were kind of off limits, and so I think people were very upset by how his stance. At least I was like, I just didn't think it was appropriate. I didn't think he did a good job, frankly, just being honest. And that's fine. No one's perfect. And so I think now the market has changed, reverted back to, as you called it, a reactionary type of market where now every economic number that comes out is going to be important. So we had the jolts today, the ISM, they happened this morning, half an hour into the market. That sold things off. You could see right there when that happened. And this was a good news is bad news. So we could also sell on a bad news is bad news. So that the economic numbers, without getting into the weeds, was basically just saying the economy's strong, still showing strong numbers. That translates into the Fed being able to wait longer until they cut more, and the market wants rates lower. Now, if those numbers were really bad this morning, then the market could have sold off because they were saying, "Oh, Powell is, is doing the wrong thing." So the market needs to adjust. It's this weird thing where we had holidays, back-to-back weeks with holidays, and then we have, of course, because President Carter, remembering him on Thursday, the market is going to be closed. So you've got all these weird things happening. On top of that, what I've been putting out there on Twitter, and I think we talked about it at least on the SMT, if not on this, was January is a very hard month. Doesn't mean a bad month, it's just a very hard month. And you remember Bill saying that, if he was ever going to take a vacation, he would take it in January. We know. Did he ever take a vacation?
Yeah, kind of. He was on vacation, and that would mean he would work a half day, right?
Yeah, if that. So, anyways, so January is a very tricky month, and so what I think everyone should do is go out to the end of January, and just do a change date and go through each year and just look at those. I would focus on the years that look like our current year, where just to keep it simple, you're above the 200-day, which is your black line. You're above the 50-day, which is the red line. And the 21-day is above the 50, which is your green line. And just go. Justin's showing you as simple as that. So you wouldn't look at that year. You wouldn't look at that year because it's a different setup. But you would look at this year, and you would look at it and say, okay, look at that kind of thicker line there that shows the changing of the year. We do that every quarter, calendar quarter. We have kind of the thicker vertical line, and you can see how the trends change. Even that little bit there on that first day of trading, that looked like a head fake, like you were going to come down, but then you got support of your 21-day, and then you went up. And just look at each one of these. You don't have to spend a lot of time on it. This is something I do every January, or actually every December, and then through January. And I just look at these and just realize there's lots of head fakes there. So, as bad as today was, it could just be one of these January head fakes. Now we've got more, economic data coming out Friday morning after Thursday being closed. And so that's going to add to the volatility tomorrow, most likely. And then we have I think the FOMC minutes come out late in the day. So just to expect more of this volatility around economic numbers. So that means you kind of have to be reactionary. And it's tricky. You and I were talking about this with Dominic before the show, of just how are we going to approach that, where you can't, it's very tricky, because if you go light into every economic number, that's fine. But then it hurts you, because then you have to play catch up when the reactions are good. When the reactions are bad, you have less exposure. So they're really, it's a personal preference thing of how much do you want to push things. So you want to be cognizant of going into like a big PCE or CPI number or employment number like we have on Friday, because that has the potential to move the market a lot, especially Fed days. But you don't want it to dictate all of your trading. So you just want to be aware of it and maybe not push it to the limit, even if things are looking good. But if things are looking bad, maybe dial it back a bit more. So
Mhm.
that's a long way of saying, be careful around them. Use the indicators that work for you. I like to keep things as simple as possible. And I like to use the 21 day, which is that green line. So we moved back below it today. Yesterday looked great with a high back, or the low back above the 21 day, which is an important thing. Now we've gone back and we've closed below it. On the good side, we haven't gone below Friday's low, which is kind of a line in the sand. There, Thursday's low is a big line in the sand. If we take out Thursday's low, then the likelihood of a much longer uh, intermediate correction is very, very high in my opinion, unless you just undercut it and immediately snap back, which can happen. But really, if you go below that, I think the market is kind of more in trouble and needs time to repair itself. But so we're on the ropes, but we're not broken.
Yeah. And you know, just kind of to reiterate, you know, we've got basically in this situation, you know, this was a little bit of a painful day that can kind of put you on your heels a little bit. You're not quite in a position of strength. We got, you know, resistance right at 20,000. I mean, yesterday we, you know, got to 20,007 and then turned tail. So, I mean, look, yesterday was well off its highs, and the selling kind of just seemed like it accelerated today. You know, and now tomorrow, okay, let's say we recover tomorrow. Let's say we recover everything. Let's say we go up to 20,000. As you mentioned, because the market will be closed on Thursday as a national day of mourning, then we'll be looking at Friday jobs report. You know, do you have enough time to kind of get in position, in a strong position to weather any storm with the jobs report, if this is now a market that's so reactionary to economic data? And look, the fact is we don't know what that data is going to be. It's not like you know, we're in trading places and we can take the briefcase and find out. It's you know, we're going to know when everyone else knows.
Turn those
So
machines
yeah,
back on,
it does
Justin.
make it a challenge. What's that?
Turn those machines back on.
Right.
Trading places.
So
Sorry.
yeah. So anyway, it's a long way of saying, look, we're in a vulnerable spot. There could be a lot of back and forth here. That is kind of the norm. In a lot of cases, yes, they might have gotten a little bit worse, but in a lot of cases, a lot of the damage was done, but you still didn't make progress. It was just kind of this really chop fest for a little while, and we have to be prepared for that. Let's talk a little bit about where we're situated right now.
Sure.
I'm going to go ahead and share our pie graph. And you'll have to just excuse me because I keep on losing my place. There we go. That's where I'm at. I'm going to share our pie graph that we, you know, tend to look at to just kind of see where things are in terms of the swing trader portfolio. As of today, a lot of cash. You know, we've got a big cash position, 58.5%. We've been kind of going with a large cash position, and then we, you know, we see strength. We start, you know, building up. Yesterday we were selling into some of the strength just because, you know, that's what we're kind of going to be doing maybe a little bit more of this year, selling into strength when we have it. We're pretty spread out. We got some in medical, we got some in leisure, we got some in energy, we got some in transport, we got some in finance. As of the close, we're kind of out of tech, you know, so
Yeah, we were forced
maybe talk
out.
a little bit about that.
Yeah, we were forced out. We were trading Nvidia and we were trading, Broadcom, but with the reactions that they had, I hated to do it, because I really think Nvidia is a great company and all, but from putting your swing trading hat on, with that type of a break, um, you know, we had to throw in the towel. We'll get back in it if it sets back up. And, the same thing with, we exited, we put the QLDs on and the FNGG on, which are, my kind of go-tos to get exposure quickly when the market turns, because that's what I like doing. It's my comfort zone of using ETFs to get exposure quickly for all sorts of reasons that we've talked about in the past. But really, it's you've got major liquidity, so it doesn't matter if you're that doesn't matter if you're trading a small account, but some people trade very large accounts. Liquidity is important to get in and out without getting hurt quick, with slippage. And I like using them as what I call an SOF, or a source of funds. where you buy them as the market is giving you signals to increase exposure. If you have individual stocks around in perfect position at that time, you go with that. But if they're maybe not ready yet, they're too far up, you go with the ETFs to get your exposure. Then you start peeling those off as you see stocks and individual stocks in position. The strategy I feel comfortable with, and it's a big part of what we do with SwingTrader. And today, unfortunately, we had to back away from our ETFs just because of what the average stock was doing. Midday, the RSP, something we weren't trading, was holding up, which was your average S&P stock, but then even that started coming down. So we had to, back away from that, or back away from the other positions, even though we weren't trading RSP because the position it's underneath the 50, underneath the 21. So it wasn't in a position to be bought, but it was certainly something worth looking at to give you a measure of breadth. Now look at that was only down 0.33. Now let's pull up SPY, which is the market cap weighted version of that. And that was down 1.13, and is up a little bit off its lows. So, it was a bad day. You don't like to see the S&P back underneath its 50-day. But I think right now in this market, the NASDAQ is more important. Maybe we could show them if you have it handy, the regression line on NASDAQ.
Yeah. Let me go ahead and switch over there. So here's the current regression line.
Yeah. So without getting into the weeds, this is something that we, Allie and I talk about on Fridays with the SMT. And speaking of Allie, you're going to be doing something with her tomorrow, right?
Yeah, she's going to be on the podcast. Really looking forward to it. Kind of her evolution as a trader and, how it kind of all came together to really give her a great year and what people can learn from that. So I'm really looking forward to that discussion with Allie. Absolutely.
Yeah, me too. So we go over these, and then you always sub in for her when she's tied up or on a rare vacation, and so we won't get into the weeds on this. Other than that, the bottom green line is very important. That's one standard deviation away from your regression line. Your regression line is your white line, and that is what I call home base, where the market wants to go back to. And so we got that nice bounce over the last couple of days, and that's why we started pressing it kind of hard, because my expectation was for us to actually go up through that white line today. Frankly, up that was my expectation based on the precedent that I was using, which we'll show in a second. But it didn't get there, because of the news that we had. It was looking like we were going to. But the market was fine until that happened. So now you came down really almost at your breaking point. I look at Friday's low is really your breaking point for this precedent that I'm using here. Let's go to that. I'm using 2013, and so I was searching through all the markets that looked similar to this, and also placing the regression on there where they were in a similar position. It's kind of hard to see, but in the middle of the chart there on October 10th, I have a little green arrow. Maybe if you can put your cursor there, I don't know if they can see your cursor on this, but that was you broke below your green line and then moved back up, and you rapidly went back through your white line up to your red dash line. And that's what I was expecting was going to happen here. So when at the top of the show, we were talking about precedents and knowing when to throw them out. And so this is not following it as with today's action, but it's not broken enough to completely throw it out. So, but if we close underneath Friday's low, then I'm going to have to throw out this precedent because there'll be too much of a difference there. And that's fine. That's an important part of using precedents. You use them while you have them. What you don't want to do is make excuses for them and be like, right. Oh, well, I'm going to use it still because I want to stay bullish. You just stay neutral and you let the market tell you what to do. So we'll see how tomorrow plays out. And more importantly, really how Friday plays out after those
Yeah.
numbers.
Yeah. Don't look for the evidence to support your position. Look for, look to change your position based on the evidence.
Yeah, that's a
um,
good. Did you
so
come up with
let's
that?
go
That's a
over
good line.
what's that?
Did you come up with that line? I love that. That's
Yeah, I guess I did.
wow. Can
Maybe
I
there was
steal
something.
can I
Yeah,
steal that from you?
absolutely.
All right.
I was trying to think of a better way of saying it, but I didn't quite come up with it. So maybe I'll work on it. Let's go over a few stocks
Sure.
because one of the examples, and I do have a position in this still myself. GE Vernova was something that we put on. We've got a nice cushion on this, especially after yesterday. But yeah, I mean, look, yesterday was a breakout, and we were selling. Why is that, Mike?
Yeah. So what we do all the time in the market is at the end of the year, you kind of do a post analysis of what you did right, what you did wrong, and what changes you need to make going forward, whether you're doing terrible or great or anything in between. It's just a process that Bill used to do well before both of us were born. And it was a big part of, what you always say, we iterate. You learn from what's working, you try to do more of that and try to do less of what's not working. And so we're going to be talking next week on a webinar on swing trading about some of the changes we're making to Swing Trader this year, based on that post analysis. And one of the things is automatically taking gains right away, just a quarter of it to a half of the position as you're starting to get those gains, and then raising our stops up. And that's one style that I've traded over the years. And, I was trying a different way, more of my shotgun thing. And I think that was just too hard for people to follow. And it made it a bit challenging too, with so many alerts coming through with the product. So we're trying to adjust, realizing that this isn't an account that I'm trading. This is something that's going out to everyone. So being cognizant of that, we're making some adjustments. So with this, when we have gains out of the gate, not on day one, not on the day we buy it, but on day two or after, if we're up a half a ATR, we're going to start taking some off on day three. If we're up, further, if we're up a full ATR, we're going to take some more off. And that's going to, should it end up helping our batting average, should it end up helping our performance as well. So that's why we were taking it. We didn't think that there was anything wrong with it. We did the same thing with NVIDIA. We were taking some off yesterday. Frankly, I thought it was going to go a lot higher, but we just said, hey, we did it with the Qs, with the QLD and the FNGG and the ARC that we were trading. It's just they were up the amount that we wanted them to be, and so we were trimming into that strength. That's what we're going to be doing until the next post analysis, and then we'll adjust and iterate, like you always say. So that was what was going on with that one. I still think it looks perfectly normal. Let's go back to the GEV. I really like how it came back today. So as everyone's doing their screening and market surge, I would use the closing range. Can you just show them where to find that closing range? Just
So if
open up.
you go to track price on market surge, and then if you just highlight with your, and for me, I'm on a PC, so that means I'm using my left click. And then you can see there's date, high, low, last, percent change, closing range. And in this case, it was a 65% closing range. So well in the upper half. Whereas if you look at, the Qs, that was a closing range of 15%. SPY was a closing range of 17%. So you automatically have kind of a sense of, oh, this, GEV was in a much stronger position. And even, I mean, if you look at yesterday, where things closed, it was in a much stronger position in terms of its close. A lot of things closed off their highs on the indexes yesterday, especially, SPY was in the lower, definitely in the lower part, whether you use true range or just the range of the day, the day's low, or the true range using the previous day's close to kind of account for the gap. I mean, GEV just looked very different yesterday from a lot of the indexes.
Yeah. So, in addition to what you were saying, I think people should screen today for anything that closed with a closing range of 60 or higher, even 50 or higher on a day like today. And that's a sign, that does Doesn't mean to buy it, but those are kind of your best merchandise. And I use closing range a lot. I mean, it's a big part of what I do. And what you always want to do is look at whatever the closing range was for the market and then screen higher. So today, with it being so low at 15, you don't want to just put a closing range of 16 or higher because you're going to get the phone book. So you still want to be relatively restrictive. So 50%, 60%, 75% or higher is depending on how many stocks you want to be looking at. And you can also do that on a weekly basis too. That's a very important thing to screen off of.
Yeah, and by the way, both of those are available if you just if you're in Market Surge and you go down to the wrench at the bottom here. I might be zoomed in too much, so it's not showing. But if you go into this wrench, you go to Customize Column Layout, and then you can choose under Price and Volume. You can choose weekly closing range. I have daily closing range already, but you can just drag those into your column layout, and yeah, they'll be there for you. Let me just move this up. Okay. Let's also go ahead and take a look at another stock that had a pretty nice close for the day. I mean, you look at the market today and you look at Boston Scientific, and it's like, what issue? There was nothing happening on the downside with Boston Scientific. A nice day where relative strength poking up in a big way, kind of clearing this area of resistance. And yeah, everything looked just fine with this one. Let's just take a look at the closing range here. This was at 77% for its closing range. So very different from the market indexes.
Yeah, so we added that to SwingTrader today, and I bought my position back. I believe I sold it before we put it on, and then because we can't have a position in it when it's when we put it on, and bought it back afterwards. And no, I think it looks like a classic, really almost like a setup day. It looks like it wants to launch higher. Now, if the market is terrible tomorrow, it'll probably bring everything down with it, including this. But this is how stocks look like before they go. So, even if you didn't buy it yet, it looks like it's still in buy range, both from sometimes what we do is only swing trades, but this one is in position for a swing trade or a position trade. Position trade meaning something you're going to hold for a longer period of time, because it looks like a classic base breakout or ready to break out. It hasn't really moved up enough to be a true breakout yet, but it's in position. So we'll see if this one fails right away. Then I think the market is unless there's something specific news on this sector or this stock tomorrow. If it doesn't work out, it's more feedback that the market's weaker than we might think.
Right. And, we were, as you mentioned early on, we were using QLD as, a market exposure. This is the leveraged QQQ, 2x leveraged. And so this is back below the 21-day moving average line, which is not where we want to be especially on leverage. So that's something that exited. But let's also talk about, go ahead.
Point on that, if you go back to the Qs or the QLD, that was bothering me is I don't mind things giving back gains, but not too many gains. So if you take the low from last Thursday and yesterday's high, and you just add those two values and divide it by 2, that's your midpoint, right? And that's for your 50% retracement. And you can always retrace 50% and still be normal and natural. And early on in the day, I was like, okay, it was just felt like the action that we were having was a gap fill, meaning, in fact, just let's pull up the Qs instead of the QLD. It's just a little different. And you can see on that gap that we had yesterday, lots of times those are filled, and it's actually healthy for the distance between yesterday's low and the prior day's high. That space, that gap, filling that gap coming down is normal and natural. So when that did it, let's go on in the intraday chart. When that was happening early on, I was like, okay, this is normal and natural, and we should have bounced from there. Once you close that gap, if you could show them the gap on there, around 519. So once it closed that gap, is like you should have moved up higher and you didn't. And that, along with the fact that it's below your 50% from those two lines that you moved, that's in a position of weakness. That's why we removed it. So you would want to tomorrow at least get up above that 50%. So just do the math, on your own, and wherever that 50% is exactly, you want it to be trading above that. That's not just for Qs, it's for the FNGG, for the SPY, any of the things that you might be looking at. And you can use that on a very small level, like, intraday. You can look at it on monthlies and everything in between. It's very important technique to use.
Yeah. And again, it's very useful for, especially for market indexes, but on a variety of instruments. It's just a very normal and natural thing for stocks to do, and gives you a sense of what, how far it can come in and where it should get support if it truly is strong. Just in the same way that we look at the regression lines, and moving average lines, it just kind of gives you an idea based on price, and really price only, what is, potentially in the cards. Of course, when it does something outside of your expectations, you have to change your expectations. Don't expect the market to change with your beliefs or your opinions. That's just not the way things work. So,
And I should mention, I forgot that I still have a position in the Qs.
oh, you know what? I do as well. Thank you for mentioning that. Yeah, I still have, I mean, with especially in my retirement accounts, I still have, I pretty much always have exposure to SPY, in those, and a little bit in the Qs as well. So, hey, I think that will kind of wrap it up for us this
Sure.
week. Again, Thursday, we will have the markets closed. We'll still be working on that day, but the markets will be closed. So we're gonna get some time to catch up on projects and things like that. It's interesting. I was telling Mike earlier. Just the fact that this National Day of Mourning happened in January, reminded me a little bit of an unusual situation back in January of 2007, when Gerald Ford passed away. The National Day of Mourning was actually chosen on January 2nd, which was really unusual because January 1st was a holiday, of course, and that was on a Monday. And so we had 4 days where the market was closed: the Saturday, the Sunday as normal, the Monday for New Year's Day, and then the Tuesday for the National Day of Mourning for Gerald Ford. Not something that usually happens, where you get 4 days closed for the market. They usually don't like to do that. That's why we're open on the market on Friday, the Friday after Thanksgiving, because they don't like to close for that long, so that people don't have the option to trade and get out of positions or into positions that they want to. So an interesting thing there. But in this case, we've got this National Day of Mourning right before a jobs report. So we've got something to look. And I would imagine that a lot of the instruments are going to be traded around the world. So that's something to just know. There could be a little bit larger reaction on either side on Friday because of that closure on Thursday. So were we going to add something to kind of close this out?
That's all I was. You picked up what I was going to say.
Oh, okay. Very good. I picked up what you were dropping. So very good. Well, thanks a lot, folks, for joining us this week. Hope you all have a great week. Don't forget, we've got Allie on the podcast tomorrow. We've got a SwingTrader webinar coming up a week from Thursday. So we'll talk a little bit more about that next week. And we hope you join us then. See you then. Take care.